Hence, if you sold it, you would get $41 back. That seems a bit low. Maybe try 190 puts. Oh, actually, we were gonna try 190. I'm sorry. I was telling myself something was off. Okay, that makes a little bit more sense now. It's 157. So net, you're gonna get 157. Your net investment technically is 19,000 minus 157, 18,843. If you think about it, sometimes when I do this, I like calculating a premium yield. So my raw yield is I get $157 on an investment of 188.43. So in 10 days, I'm gonna get 83 basis points. The APR number would be 0.0083 times 365 divided by 10. So that's about 30% premium yield. This means if the option finishes out of the money, you effectively made an annual interest rate of 30% on your investment. If you are willing to do a little bit more, if you can live with buying it at 200 puts trade on at much bigger, about 490. Which means net investment is 20,000, because now you have to put 200 times the 100 minus 490. You're putting $19,000, 510. So the so-called yield is going to be 490 divided by 19,510. That's raw yield. And that means you're going to get, if the option finishes out of the money, you would have earned 2.5% on your investment. Or the APR is, right, I'm going to multiply it with 36,500 to get a percent number directly. So your APR yield is 90%. And 1 week from today, all you have to do is roll it over. For example, let's look at the March 1 number, okay? Which is this Friday. Suppose you're holding the 200 puts, or you had sold 200 puts, whatever price it was, we don't know, but right now you can buy it back at 267, and you can extended to March 8th at 490. Okay. Typically, I do these the morning of the day of the exercise, but sometimes I do it the day before, especially if the option is out of money. You know, you want to use passage of time. Look at the theta on this option. It's 0.71. That means if nothing happened to Tesla price, tomorrow morning this option would be trading at 70 cents less. Okay. By Friday morning, it would trade around buck and a half less because there is time value in it. So you might as well use it since you're short these options. When you short an option, theta is your friend. Okay. And the higher is the theta, the more money you make just by waiting if nothing happens to the stock, or as long as your option finishes out of money. All right. Do you guys have any questions on how to kind of think about these? One kind of rule is don't do these strategies if the implied volatilities are low. For example, suppose you are thinking about a covered call strategy for SPY. I mean, you think stocks are good overall, but you don't necessarily think that they're going to go up by too much in the near future. Current price of SPY. In case you didn't know, SPY is the ETF for S&P 500 stock index. In fact, let me call WOO because this is same thing by Vanguard. It has a much lower management fee compared to SPY. So let's go to SPY, WOO. And if you want to know about it, expense ratio is 3 basis points. So for each $10,000 investment, you pay only $3 per year as fund expenses. On the other hand, SPY is 9, so it's 3 times as much. So let's go to WOO. Okay, it's $465. And let's say 500 call, March 8th expiration. Sells for about WOO options. Sell a call on. Oh, this doesn't even have anything before March 15. Not all stocks have all the dates. SPY would have March 8th, but in this case, let's see, 500. Go up, not down. It's trading at pretty much 5 cents. Not much going on. Okay, let's try SPY. They tend to be more active for option purposes. So their current price is 505. So let's change our nodes. And let's do a 525 call, which is about a 5%, roughly 5% increase. Mm, 4 maybe. And they have a lot more dates for uh, SPY strike prices. So 525 is trading at 6.5 cents pretty much. Let's call it 7 cents. That's not much of a value, okay? So let's try anything lower than that. How about 515? This being an index, it's not going to move too much. It's about 76 cents. And let's say